The similarity between both types of audits is simply that both involve an auditor examining information related to an accountability relationship and reporting on it. The differences, however, are as follows. In traditional financial statement audits, the objective is to give an opinion on the financial statements. However, in a value for money audit, the mandate can provide the auditor with the discretion to establish the audit objectives and scope, and these audit objectives and scope can vary from one audit to another. Another difference is that value for money audits can address a variety of matters that are not necessarily of a financial nature. An example of that can be human resource management. With value for money audits, there is no body of standards or generally accepted criteria that are being followed by the auditor, such as with a financial statement audit. Because value for money audits can cover a variety of matters, multidisciplinary team members may be needed to a much greater extent in a value for money audit than in a financial statement audit. Finally, value for money audits may not relate to a specific or a standard time period, such as a fiscal year, as we know financial statement audits do. Next, we'll be talking about planning a value for money audit. A value for money audit, the audit plan would constitute of the auditor's understanding of the entity. By understanding the entity, the auditor can better establish the audit objectives and scope, assess the suitability of criteria, and determine if sufficient appropriate audit evidence is likely to be available. The auditor should communicate his understanding of the entity to management in order to avoid possible misunderstandings. Next, we have the audit objectives and scope. The audit objectives and scope for a value for money audit provide the framework for the audit. Audit objectives outline why an audit is being conducted, while the audit scope defines the matters and the time period covered by the audit. When assessing the audit objectives and scope, the auditor needs to identify all areas that are significant for achieving value for money, or areas of high risk. Significant areas where the risk is assessed to be high should always be examined. Significant areas where the risk is assessed to be low might also be examined, since any evidence of a lack of regard to value for money may have significant effect on the entity. Areas that are insignificant, whether the risk is assessed to be high or low, may be reviewed by the auditor to confirm if his or her judgments, but would not necessarily be examined in detail. To confirm his judgments, but would not necessarily be examined in detail. Next, we have the planned criteria. Audit criteria are the standards against which the performance of the matters subject to the audit is being measured. The level of detail in the audit criteria specified affects the level of detail in the audit conclusions. In order to identify the probable nature, sources, and availability of evidence, the following factors should be considered. First is the effect of the audit approach. The ability to integrate audit work with other audits, the effect of the reporting requirements, and finally the cost of obtaining the evidence. Next, we have the resources required. The auditor would consider if he or she has the necessary resources to conduct the audit, such as if there are sufficient qualified personnel available. The auditor can also assess the resources available within the entity. For example, the external auditor can use the work of the internal audit function. For the work schedule, the auditor should take into account his or her own planned audit cycles. Additionally, the circumstances of the entity need to be considered. If an entity is about to undergo a major change in its operations or objectives, then a value for money audit may not be meaningful if it's conducted right before that change. Finally, we have the reporting requirements and the timing of the report. The audit should be planned to ensure that the results of the audit can be reported in a timely manner to actually meet the specified reporting deadlines.